Welcome to the Ultimate Trader webinar series. This is webinar 1, Psychology and Price Action. Welcome, my name's Greg Secker. I'd like to welcome you first of all to the first webinar series and dive in on psychology and price action. This is the first module of a series of 7 that's really going to focus on some of the core components that we discussed in the Ultimate Trading Secrets document. Now, first off, humans are hardwired for failure when it comes to trading. Particularly, the mind, which is controlled by the conscious and the subconscious, generally is pulled in the wrong direction nearly every time when people look to place trades. The reason for that, of course, is that most people are driven by excitement and social proof. In other words, when they see stocks, currencies, indices, or commodities moving very quickly in what looks to be a profitable direction, people can't help but enter those trades. You know, the adage is the stock is moving means really the stock has moved, and therefore is your signal to move on. Most people cannot help but wait to see a stock break out in an excited fashion and then look to enter the trade only to see the stock, currency or commodity reverse on them almost immediately. Let's take a look at that in terms of a diagram. Imagine we have a stock which is trailing along in a relatively boring fashion. Notice that our would-be trader there, as you can see, is very bored by this sideways trailing movement. There is little excitement. But then all of a sudden we notice that the stock starts to break out. As soon as that happens, this sudden movement causes a level of excitement. Notice the extension of the bar there breaks up through that small consolidational range that we can see here. Excitement builds. As it continues to then break out, excitement builds further, and we start to see some social proof. Now, social proof means other people are doing the thing that we are thinking about doing. This is like saying, I'll be happy to jump in the swimming pool, but I'm waiting for you guys to get in there first. Then, of course, we see the intrepid trader can't help but enter a trade. Notice my example here is £50 a point. In other words, they're placing a trade of every penny or point this stock or currency moves up, they stand to make £50. Notice the next move. The stock continues to run as soon as they've placed the £50. And watch what happens. They've moved 20 points. And notice the yes. This is the case of the stock has run 20 points. So essentially they've made themselves a profit of £1,000 in a very short period of time. When that happens, the brain picks up, or the subconscious picks up, on this very exciting, highly emotive period of time. And what the subconscious is really constructed to do is look for things which happen consistently when we experience periods of pain, and as well we experience periods of pleasure. So clearly the subconscious's job, that's represented by the blue cog here, really controls the things we do in life, our actions. And if we experience pleasure, well, the brain is constantly searching to see what's happening consistently in that period of time, and will also look to do that in the future. If we experience pain, the subconscious part of the brain is going to be looking all the time to see what's happening at that period of time too, and will try and move us away from that. The subconscious's job is to avoid pain, whether that be financial or emotional or otherwise, and move us towards pleasure. Clearly, when the stock moves 20 points in only a relatively short period of time, 2 hours, and a profit of £1,000, whilst unrealized but is seen on the trading account, the emotional experience and the hard wiring gets linked up that, boy, when a stock breaks out like this would be an ideal time to place the trade. For any of you who are aware of what a stop loss is, i.e. the order to close a trade if it moves against us, you might wonder, well, wouldn't the intrepid trader here move their stop loss up close and try and capture that profit? Generally, when a stock moves that quickly in a short period of time, somebody who's made £1,000 in 2 hours probably thinks they're going to make more money on this stock before it's all said and done, so they wouldn't want to get taken out at the £1,000 level, and they'd leave their stop loss some ways down here. And of course the stock starts to come off, and then the profit shrinks from £1,000 to £50 and then lower. Now the loss is £1,200, and then finally the loss is so strong, now it's £2,400. Our trader exits the trade and tries to forget all about it. Now, the big problem here, of course, is this happens thousands and thousands of times every hour across major brokerages around the world. And of course, this will always happen because people will always buy on greed and then they'll sell on fear. And clearly, people need those two psychological elements, as we discussed before. It has to be exciting and there has to be some social proof. And when that crowd volume is in the move, the next step, of course, is exhaustion. And that's when, of course, the stock then retraces and pulls back. And what we've got to do psychologically is avoid that temptation to be pulled in by that crowd excitement. In other words, we must follow a structured trading plan. First of all, let's have a look at how the mind is put together. Essentially, you've got the conscious mind, which does all our rational, our analyzing, and our thinking. And that's really responsible for our decision making. We do all our talking here. We do all little action here. So in other words, there tends to be a big difference between what we say we're going to do and ultimately what we do. That's what we define as really our subconscious. In other words, the actions we take is generally based on how we feel about certain things as opposed to what we think about certain things. In other words, what we consciously rationalize, in other words, oh yes, I'm going to go to the gym every week, well, does that actually materialize? If it does materialize, it will be because we have linked up strong positive associations with going to the gym. We may enjoy going to the gym, we may like the people there, we may enjoy going on the treadmill, and we may become addicted to working out. However, if we enjoy going to the pub and hanging out with our friends at the bar, we'll see less of the gym, and ultimately we won't attain our goal of becoming fit. So it really is more the subconscious which controls what we do, the conscious which really does all the talking and thinking. Remember that all of our actions stem from what we have psychologically and subconsciously linked up as painful or pleasurable. Now let's go back to that original example that we just looked at. Notice that here, when the trader gets pulled in under the excitement, of course, this happens in a highly emotional period of time, and the subconscious is constantly monitoring what's happening that's good here. And of course, when someone makes £1,000 or £2,000 in a short period of time, they really think they've cracked the trading code. Of course, that ultimately then ends in disaster, as you can certainly see in the latter part of this diagram. And what people tend to do when that happens is because they don't want to focus on the pain, they then try and sweep the trade under the carpet and say new trade, new day. And really all they're doing is preserving that same error for another day. That same person will do exactly the same thing on maybe a different stock or a different currency at a different period of time. And the reason for that, of course, is because their brain has become hardwired to excitement. In the trading game, we've got to do the opposite of that. We've got to look for what the untrained eye would probably describe as a boring trade. What's happening here? Well, the subconscious is getting hooked on the exciting trade as it's receiving immediate positive feedback. Remember, we live in a society now where people constantly want to see immediate feedback for the action that they take. People want immediate returns, immediate results. And what we've got to realize is that trading is all about setting up a highly probable trade, putting risk first, and then ensuring that we take our profits calmly. Remember that the subconscious's job is to be responsible for our actions. And if we get hardwired into placing trades which are exciting, this generally ends in disaster. What would be the solution to this? Well, first of all, we've got to do the opposite to this. And this is generally very difficult for people to understand. In other words, we've got to look for trades where the entry into the trade, when we're placing the trade itself, it's got to be elegant. In other words, the bars on the chart should not be big and it should not be moving. Crikey, if somebody is saying to you, hey, it's moving, you should be saying, and that should be a signal to move on and find another trade. We've got to find something which represents a relatively low risk opportunity and allows us to get in to take the move before it happens. We must also be able to place a stop loss which is somewhat protected. In other words, if you're entering a trade, whether it be currency, whether it be stock, and you're literally getting in on the moment of excitement where everything's breaking out wildly, the chances of you getting whipsawed out where the stop loss pulls back and hits, where the stock pulls back or the price pulls back and hits your stop loss is very high. The chance of failure at that moment is extremely high, and ultimately the chances of success is massively reduced. So let's take a look at the solution on a chart. Now imagine a stock's in an uptrend, as you can see here. Notice this graphic shows the stock moving up with a nice blue moving average line running upwards in the same direction as the stock. Notice here, at this point here, at the top, this would be the wrong place to buy the stock, to get into the move or to go long. Why? Because it's likely when the stock price pulls away from the moving average, it's going to pull back. Why? Because stocks, currencies, commodities, indices never move in a straight line. They must always go through cycles. The cyclicity of markets is implied with the buying and selling and the nature of market dynamics. In other words, a market must pull back and then resume. It must exhaust and pull back to the trend. And notice what's happening here is the stock pulls back to the trend, and as it does that, we then look to enter the trade after that resumption has taken place. In other words, the price action coming back in and moving back upwards. It's all about getting the timing right. It's all about understanding the character of the nature of the movement of stock price action. And that's exactly what we're going to show you in the Supersized Trading Income modules. We're going to show you not only when to get into the move and take maximum profit from it, but what things should we be looking for? What particular strategy should show us exactly when to enter the trade, what the configuration of the price bars need to look like, and then most importantly how to automate that process so we can literally use simple brokerage platforms that will enable us to enter these trades almost automatically with very little input from yourself. In other words, you'll be there with the system itself scanning for those trade setups, and it will be showing you those trades which are pulling back to the trend, which are then turning around again and continue going, and then you'll be able to automate the entry of that into your trading account. Where would we place the stop loss? Well, clearly a stop loss has got to be put, as we said before, in an area which is protected. And therefore that means putting that stop loss outside of that original trend so it's unlikely to get hit. In other words, outside of either the major moving average or the uptrend there. Well, that concludes the Ultimate Trader webinar series, Module 1, Psychology and Price Action. Look out for the next modules where we're going to cover all the elements in greater detail that we discussed in the Ultimate Trading Secrets document.